of... Alright guys, very warm welcome to another week ahead video. This week's video will cover the trading week running from Monday the 5th to Friday the 9th of July 2021. Now our main attention and focus this week will be on the Aussie dollar, with the very important and highly anticipated policy meeting coming up for the RBA on Tuesday. Now, as a pro-cyclical currency, the Aussie dollar has enjoyed a very healthy push higher from March last year, alongside, of course, the almost effortless grind higher in risk assets like the S&P 500. On this chart, we can see the S&P 500 E-mini in red, and in blue, we have a currency index that we've built inside TradingView versus the majors. Now, what we can see here is that the Aussie dollar has mostly followed that move to the upside. But what you can also see is that that upside move has ran out of steam from the second quarter of this year, as the RBA, just like the Federal Reserve until the FOMC meeting that we had in June, the RBA has stuck to a very dovish script and stayed persistently dovish, even while other central banks like the RBA and the BOC took a more hawkish turn. In the more recent policy communication over the past few months, the bankers have explained that they will maintain highly supportive policy conditions until they have reached full employment and have inflation sustainably back inside their 2 to 3% target range. And the bank also explained that they didn't really expect those conditions to be met until 2024 at the earliest. Now, even though the monetary policy divergence was, of course, a negative factor, there was ample amount of continued support from other drivers. The most important one was, of course, China's very robust recovery that saw a huge demand pick up for Australian exports. We had COVID-related supply bottlenecks, we had rising inflation expectations, and of course increased demand from China over the past few months, which was a very conducive environment for key commodities for Australia like iron ore, which, as we can see here, makes up about 24% of total Australian exports, and almost 82% of that is sent to China alone. Now, apart from the terms of trade strength due to the rise in commodity prices and demand, the overall weakness during this time for the US dollar was another additional support for the high-yielding, pro-cyclical, and of course commodity-linked currencies like the Aussie dollar. Now, from an economic point of view, as you guys know, Australia did a very good job in handling the virus outbreak last year, and combined with their coordinated fiscal as well as monetary policy support, the pandemic hit to the economy was much smaller than previously feared by the Reserve Bank of Australia. Now, even though recent data points have been holding up fairly well, the most recent May jobs print really gripped the market's attention with a hugely positive print of 115,000. Apart from that, the unemployment rate, as we can see here in purple, dropped right back down to 5.1%. Now that is back to pre-pandemic levels. Now the size of this beat saw plenty of market participants push back their dovish expectations for the Reserve Bank of Australia, with Westpac actually now looking for a potential first hike from the bank by the first quarter of 2023, because they think, according to their forecast, Australia will return back to full employment and 3% inflation by the first quarter of 2023. We also had other players like CBA actually seeing or expecting a first hike as soon as November 2022 or November next year, with a potential cash rate sitting at 1.25% by the third quarter of 2023. So these are very aggressive repricings that we've seen from a couple of market participants going into this July meeting. Now that, of course, brings us to that week ahead meeting where we have the RBA policy decision coming up on Tuesday. Now, the bank has previously stated that they will use this July meeting to decide whether to keep the April 2024 bond as the 3-year yield target bond, and will also decide the future of bond purchases after the current tranche ends in September. So we already know this is going to be an important meeting for the bank. Now, the topics that the markets will watch, of course, in this meeting, firstly, like we said, what they're going to do with that 3-year yield target bond. Secondly, what they're going to do with asset purchases. And then thirdly, what they're going to say about forward guidance. On the first one, the 3-year yield target, right now consensus is firmly in the camp of expecting the bank to retain the April 2024 bond as the 3-year target bond. We've had a few different participants recently highlighting that if the bank were to extend the target to the November 2024 one from the April one, that would actually signal that the bank now expects to keep rates on hold until 2025, which right now seems highly unlikely. What's interesting though is that a couple of hawkish participants are actually looking for whether the bank could potentially surprise more hawkishly by actually shifting to a 2023 bond as the target. Now, that would certainly be a very hawkish tilt from the bank, and it would signal for the markets that, hey, we are expecting a first potential hike for 2023. Right now, though, with half of the population back in lockdowns, it does seem that this would arguably be way too aggressive of a move for the bank at this stage. Now, when it comes to bond purchases or quantitative easing, consensus here is a little bit more unclear what the bank is going to do. There's a couple of options they have right now. The first one is for them to completely stop asset purchases. Now, that seems highly unlikely if you read through the minutes of their prior meeting. This isn't a bank that sounds ready to completely scrap asset purchases. That means that the other options on the table right now is to see whether the bank announces another 100 billion Aussie dollar program, let's say running for between 6 or 12 months, whether they will opt for a more reduced program of not 100 but rather 50,000 Aussie dollars, also running for another 6 months, or whether they will potentially choose a more flexible open-ended program, seeing them buying about 5 billion Aussie dollars per week. Now, what's important here is that the markets have already completely discounted an increase in quantitative easing. So the focus for the bank will be completely on what their willingness is to slow the pace of quantitative easing. Now, given the good jobs data, most participants just a week ago were very sure that the RBA would potentially opt for a 50 billion or that flexible option, taking more of a weekly purchase. But after the recent COVID lockdowns, the water is a lot more muddied right now on what the bank will go for, and consensus really isn't clear on what the bank will announce in terms of quantitative easing. Now, when it comes to forward guidance, the biggest focus point for this meeting will be whether the bank drops their prior language that they don't expect their goals required for a first potential rate hike to be reached until 2024 at the earliest. If they're going to drop that tone, that's obviously going to be more of a hawkish tilt from them. If they're going to stick to that language, that's going to be more of a dovish tilt from the bank. Now, as markets are currently pricing in between 50 and 65 basis points of tightening by the end of 2023 already, which in our view seems a little bit too aggressive. An RBA that comes out this week and that just sticks to their dovish guns and doesn't bring forward rate hike projections in line with these expectations is arguably going to be the biggest risk for the Aussie dollar in the week ahead. Now, one thing that some participants are latching on to, saying that, hey, we anticipate the bank to take a more, not necessarily an overly hawkish approach, but for them to step away from that ultra dovish approach, is the fact that now the FOMC has also taken more of a less dovish tilt with that prior FOMC meeting that we had in June. For some participants, they say that the RBA has basically waited for the Federal Reserve to make the first move, and now that they have made the first move, that'll give them a little bit more conviction to do the same. So looking at a potential trade plan for the week ahead, the one big benefit for the Aussie dollar going into this week's RBA policy decision is the fact that some Aussie positioning has already been washed out after the recent upside moves we've seen in the US dollar. So as always, we'll be keeping a very close eye on pre-positioning for signals on market expectations going into the event. But right now, where we're looking at in terms of the data we had on Friday, it doesn't seem that the market is really priced for a very hawkish tilt from the RBA on Tuesday anymore. Of course, like we said, that can change, so we will need to keep a very close eye on pre-positioning going into the meeting. Now, taking a look at the three possible scenarios, above we have a potential hawkish outcome, in the middle more balanced outcomes, and then third one potential dovish outcomes. Now we're looking at the Aussie 10-year, and that is the Aussie 10-year bond yield. We're looking at the Aussie dollar in general, and then we're also looking at the Aussie CAD and Aussie yen, because we do still have a bearish fundamental outlook for the Japanese yen. Any upside in the Aussie dollar we think is good to pair that versus something like the Japanese yen. For the Aussie CAD though, this one is more interesting, because even though we do still have a bullish fundamental outlook for the Canadian dollar, we think a lot of the positives for the CAD has already been reflected in the price based on the price action over the past couple of weeks. So any type of upside in the Aussie could be a good opportunity from a catch-up value trade point of view for the Aussie CAD to the upside. Now, looking at potential hawkish outcomes, the first one will be on that 3-year yield target. If we see them adjusting to a potential 2023 bond, that's going to be a very bullish outcome. Secondly, looking at the QE program, if we see them opting for that more flexible open-ended QE of 5 billion per week, that's going to signal that they are moving towards a potential tapering environment. So that's going to be a positive. In terms of forward guidance, if they bring forward their rate guidance to a possible hike as soon as Q3 2023. That's going to be a bullish outcome. If they talk down negative implications of the current virus situation, that's also going to be a tick to the upside. And then if they say that the recent jobs print is the reason for their optimism and they expect a lot more of those types of prints, that's obviously going to be their way of saying that, hey, we think the conditions for us being ready to hike is going to happen sooner, and that'll be more positive for the Aussie dollar. In terms of balance outcomes, here we expect them to basically keep that 3-year yield target on the current April 2024 bond. Not expecting a whole lot from that because that's largely consensus right now. In terms of QE baseline right now, we think is the market's expecting a 50 billion for another 6 months. Like we said, the markets is the waters is a little bit more muddied on this one. So if we do see them scaling back to a 50, which we do think is more likely, we would expect that to create some upside for the Aussie dollar. But again, they could also go for 100 based on the virus situation. So right now, we think the market is closer towards that 50. But again, that's more of a muddy one right now, given the virus situation. Thirdly, if they keep the current language, the conditions for rates are only going to be reached as soon as 2024. We expect that to be negative for the Aussie dollar, but in line with the others, probably more of a balanced outcome. Fourthly, if they talk about the uncertainty around the virus situation, expecting that to be more balanced because, again, that's not really new information. And then fifthly, if they say that they're happy about the recent jobs gains, but they don't want to fixate on one particular print, that should also be more negative because there's been a lot of positive pricing coming out of that event. But again, not expecting that to be necessarily something to trade negatively for the Aussie dollar on the back of, unless we see some aggressive repricing, of course. From a more potential dovish outcome, we're looking for them to adjust the 3-year yield target to that November 2024 bond. If they do that, that's going to signal to the markets that, hey, we're not ready to hike rates at all, potentially even moving into 2025. So that'll be a real dovish tilt from the bank. If they announce that additional QE of 100 billion for another 6 or 12 months, that's also expected to be more negative. If they keep the current language that conditions for rates are only seen from 2024, expecting that again to be negative. If they stress that the virus uncertainty risks pushing back their high conditions even further, again going to be more negative. And then if they downplay that recent jobs gains and say that, hey, we think this is just a one-off and we expect these gains to moderate, also expecting more of a negative outcome for the Aussie dollar on the back of that. Now, guys, do remember that the potential outcomes and the potential market reactions in this report is merely a guide for what we would expect in the event of the various outcomes, and that the market can always surprise in the way that it reacts. So this information is never intended as a trade call, but rather intended as a framework for you to use in your own scenario planning. So that's everything from our side, guys. I hope you guys will have a fantastic trading week ahead. I hope you all the success with that RBA policy meeting. And as always, any questions, don't hesitate to let us know.